What is the fair market value of XRP? We released our comprehensive white paper today, and I wanted to take some time to explain sort of my POV on it, some things that I think are key highlights, and walk you through some things that have been common areas of confusion. Hey, welcome to the show. Molly Elmore here. Today I'm going to walk you through the white paper that we just released called A Comprehensive Approach to the Fair Market Value of XRP. This has been a project that has been in the works for quite a long time. It actually predates even my involvement. Jimmy Valley and Val Hill Capital started this very long-term project about 2 years ago. And it initially started because there was some sort of suspicion about the SEC versus Ripple lawsuit. There was just some things that didn't really seem right. And if you were to ever hypothetically try to sue the US government for damages, the first question that comes up is, well, how do you decide what those damages are? How would you decide the amount of financial harm that was caused by this lawsuit? And that is a series of sort of questions that led to the evolution of this project and a team being formated that we refer to as the Valuation Committee, which is part of a larger confidential committee that was formed initially in 2021. But I kind of got involved in November, December-ish of 2022, so about 6 months ago. And so there's a couple kind of questions that come up that I'm just going to address. One is this idea of this confidential committee that they're like, well, how is it confidential if I know about it? What that just really meant was that people could participate on the committee and not have that participation disclosed publicly. There's definitely reasons why someone, for their career or whatever, that if they work at a bank, let's say, or an investment bank or hedge fund, they might not want to disclose that they're participating in this project. So the committee itself was never confidential, but the people who participated, some shared their participation, but some kept that confidential. But separately, a smaller group was formed called the Valuation Committee, and I was still a member of that. And we've put together this paper that is an analysis of 6 different models that were built. I want to explain a couple of clear, important things before you choose to read through this and draw your own conclusions. The first common misperception is that these models are forecasts or price predictions. They are not at all. They are simulations where a model builder took a series of assumptions and said, if these conditions were present, what would the price of XRP be under those conditions? And by design, it just actually kind of worked out this way, but it's pretty cool. We have some models that look at extreme scenarios, like if all of the money in the world were being transacted on the XRP ledger, what would the price be? Similarly, if all of the money in the world were being stored in XRP as a store of value, similar to how gold is the store of value, what would the price be? And some of the early criticism, which was actually helpful because it made sure that this paper addressed this, was that, well, that's not likely to happen. And we're like, okay, the point is that this is a simulation model looking at what the price would be in those conditions. Because the truth is if there ever were to be a lawsuit to look at damages, and I'm no attorney, so this is not me saying anything legally binding or legal advice or anything of that nature. This is my understanding of how this would work. If there were a lawsuit, like a class action lawsuit, and the retail holders who had XRP back in 2020 they sued saying you harmed my portfolio. Sometimes you can use a worst case scenario argument to say, an extreme situation could have happened. We could have seen all the money being transacted or all the money being stored in XRP or all the money being transacted on the ledger. How could you say otherwise? You don't know. You had this lawsuit and you suppressed the price and affected the market situation. So this was one of the points of contention that came up as we analyzed these models over the period of the last few months and summarized them in this paper, is that none of these are price predictions. They are simulations, and they are looking at specific conditions to see what the price would have been in those conditions. And it's unlikely any of these models will actually play out in real life. They can't, right? The lawsuit manipulated the market, meaning it created this artificial fear that the XRP ledger, might not be a good place to build your business or run your software or whatever, because of this uncertainty around the token XRP being classified as a security. So because of this sort of dark cloud that has hung over the XRP ledger and XRP in general, it dampened adoption. It slowed down development on the ledger. Like people who have a lot of money who are investing in blockchain projects were less likely to do so on the XRP ledger due to this lack of clarity. And while developers are still eager to build on there, the reality is that most people still need to get paid to work. And if there's less money being invested in the XRP ecosystem because of this lawsuit, that is a problem, and that is financial harm. And that is what these models could potentially be used for. I'm not a lawyer. I'm not suing anybody. I'm not part of any class action lawsuit. But this paper was written with that possibility in mind. Like if somebody wanted to quantify the financial harm that this lawsuit happened, how would you go about it? And these 6 models look at these assumptions. So I just want to walk you through a couple of things. You're obviously more than welcome to read it. One of the things that was pretty important to understand was that there was a series of different variables that we looked at. We looked at transaction volume. We looked at the total money supply in the world. We looked at daily transaction volume. We looked at some of the circulating supply that's available, because if it's being held in escrow accounts, for example, or being held off sort of in wallets that are not available for transactions, that affects the amount of value that's available. We looked at things like discount rate, which is common in accounting and investment banking. When you're looking to value things, you need to understand what is the future cost of money. We also looked at the years until we kind of got to this, what we call the steady state, as well as the transaction per second. So there was quite a few different variables that fed into the models. Not all models cared about the same variables, which is actually pretty cool because each of them gave us a different viewpoint on this particular ecosystem. So I have this slide, this graphic here that does a nice summary if you wanted to look at all the models next to each other. I know there's 6 models and there's 7 columns here. There was one model that was built where we differed a key assumption in 2 different viewpoints. And this had to do with how much money was being what we called collateralized on the XRP ledger. We had one scenario where it was all the money, and then one scenario where we just looked at 10%. And so I wanted to reflect that differently in this graphic. The most important sort of concept I think that this analysis and this paper seeks to address is this idea of fair market value and how it is different from market value. I've made other videos on it, I've written threads on it, and it still gets back to this point where it's difficult to understand that what you see on the exchange is not what is called the fair market value. The best way I like to look at this has nothing to do with XRP or digital assets, but with real estate. And I'll link the video I made explaining this in more detail, but let's say you have this beautiful house that is worth $1 million today, right? And you rent it out to somebody, and this somebody comes along and has a party, and some horrible, horrible thing happens at this party. And now there's like a stigma with this house. Nothing was damaged. Like the house is still beautiful and pristine, but now there's like a cloud hanging above this house and nobody wants to buy it because of this horrible, horrible thing that happened at the house. It's like considered haunted or cursed or whatever. I'm just making up this example just to make a point. So now all of a sudden the house is not sellable, right? So the market value of this house is going to take a hit. But the fair market value is what it's actually really worth based on a bunch of criteria, like comparable houses in the neighborhood, the quality of the construction, the design elements, like all the things that like are objectively analyzed, those contribute into the fair market value. Fair market value is not volatile. It doesn't change. It's not subject to kind of market perceptions. Other than if an entire area was suppressed. But let's just say in my example, we have this one house that has this dark cloud over it, but all the other houses in the neighborhood are selling like crazy or valued very high. That's what the fair market value would be based on, is if you took out this sort of incident that put the cloud over the house, fair market value would be what it would be worth if that hadn't happened. But the market value is the reality of what it's selling for because of emotion and market perception and all those other things. So I'll link the video in detail, but it's really, and there's a page in here that I suggest you read if this isn't a concept you don't quite grasp. but the fair market value and the price of something on an exchange are not the same thing. They could be hypothetically in a market that has no manipulation, but we live in this world of media. We live in this world of chatter and groupthink and trends, and those all affect the market price, but they don't really play a role into the fair market value. So we were looking to assess, all right, let's take all emotion out of this. Let's take all the drama, the lawsuit, and let's look at some scenario and conditions to determine the price. What would it have been? And we fortunately had model builders who built these extreme scenarios so that we could understand if you only cared about store of value, what would the price be? If you only cared about transaction utility, what would the price be? We were able to create this range so we could understand what really are the drivers. So please, if you look at the summary thing we call the football field that shows all of the data points, outputs from the various models, none of these are price predictions. We're not saying any of these things are going to happen. It's actually extremely unlikely due to the fact that this lawsuit suppress the market price of the asset. They probably won't. Now, humans are resilient. People can make up for lost time. Should this lawsuit end and adoption starts to grow at a very, very accelerated rate, we could make up for lost time. But I don't know which one of these models will play out because we don't really know how much people are going to store their value in XRP. We don't know how quickly businesses and banks will start to adopt. So again, none of these things are predictions. We're not saying these are going to happen. And that seems to be the most common response from people who just look at the numbers in some of these graphics that we've shared is that I think or someone thinks that the price of XRP is going to be 20,000 or 50,000 or 100,000. No, I don't think any of those things. I do, however, believe that if certain conditions were present, then the price would be X, Y, or Z. And that is what the models are intending to convey. All right, what else do I got in here? So this fair market value thing is not something I made up or anyone made up or Jimmy made up. And I pulled a bunch of information from the IRS's actual website to talk about how when there are factors that affect perceptions, it impacts the market price and how that differs from fair market value. So there's a great slide in there. If you want to hear in the IRS's words directly how they describe this concept. Virtuous Cycle is one of my most favorite ideas that I learned about throughout this process. And this has to do with almost like a tornado where you have this whirlwind virtuous cycle flywheel. And what happens is you have two forces. You have the force of using the asset, in this case XRP, for utility. You have this force of storing your wealth in there. So what happened? Well, likely this is a scenario that could play out. Lawsuit ends, everybody's excited. People start to use XRP for cross-border payments. Maybe they start to make payroll, like all sorts of other reasons that people send money to each other. Specifically, businesses send money to people and businesses send money to other businesses. Stuff that's at scale beyond like you and me sending money to each other as peer-to-peer. So once this happens and there is more utility adoption, the price is going to go up. Then you've got all these countries around the world and banks around the world and very large businesses around the world that participate in global trade. They have to store their wealth somewhere, right? They could store it in dollars. That's what's been done for a long time. They could store it in gold, whatever. It's up to those individuals or entities to decide how they want to do that. Why wouldn't you consider storing your wealth in something that's going up in value because you're watching adoption grow, right? So what's going to possibly happen is more and more of these large entities are going to store their wealth in XRP because you got to store it somewhere. And so what happens then is there's less available supply for transactions. And so the price of the transaction thing starts to go up even more. And then all of a sudden people see the price go up higher and they're like, oh, I got to store more and more wealth there. And it creates this dynamic flywheel where these two variables interact with each other, kind of like a cyclone, like a tornado. And that is what's known as the virtuous cycle and could lead to quite possibly exponential growth because these two factors compete with one another. All right, so we do have this football field cross-model comparison. The idea here, in my take, was that we just wanted to show all the values in one place. And as a statistician, when you do a lot of sampling, which this isn't really sampling, but wanted to say, well, what happens if we just sort of take out the outliers? As I mentioned, we built some models with very extreme conditions. So let's take those extreme condition scenarios out. And let's just look at the middle range of values in between the median and the mean and sort of see like, what is this hovering around? So if we had to make generalizations across all the models, what are we seeing as sort of like the convergence point? And 12K is sort of where the values converge. And we see obviously some higher, some lower. So if I had to pick a number that's saying if we were to model, what the outcome, what the value would be in certain conditions, and we wanted to look at a variety of conditions, where does it converge? 12K is about the average. Now, the thing about this, if you go back to this virtuous cycle idea, is that unless there's some entity that we're not aware of who's going to set a fixed price or control the price, which could happen, but different discussion, the price probably won't be static ever. Like the virtuous cycle means people are using it, adopting it more and more supply gets pulled out for store of value, use it more and more supply gets pulled out. And it creates this constant sort of growth cycle, which means that price is going to continue to go up, and maybe it'll be volatile and go up and down, but I don't personally think that we're going to see a one price. Now, we could get into a situation where the banks or whatever agree we're going to have a minimum price and that they won't agree to buy or sell it below that. That kind of thing has happened before. But that is beyond the scope of this paper. I'm just sort of talking about where I saw the value converge. All right, so then we have a series of two pages per model. One is what I call the scorecard, which just kind of breaks what is the approach, what are the assumptions made, what is the methodology, what are the conclusions. We did that for each of the 6 models. I'll let you read those yourself. And these infographics I actually created months ago when we first introduced them on Twitter. I don't think any of them really changed for the most part, but they do sort of show you the unique kind of conclusions from each of the models, the whether or not they were extreme, whether they looked at both store value and transaction utility. Because to me was the most fascinating part of all of this. Is I wanted to know, like, what makes the price of this asset go up? Like, what are the drivers of it? And what we learned was that transaction utility, while it is very useful and practical and solves a problem, it's not a huge price driver, because you can use the asset and then give it back, right? Sell it, change it, give it to someone else to use for a transaction. It's a short-term commitment. But the store of value thing is totally different. And I know that some people in sort of the tech space appreciate the utility alone. But the thing is, if the price is going up because it's being adopted, and it's something that I use regularly, let's say I'm a country and I participate in global trade, and I have a surplus of money that I got from trading, I could swap that back into my native currency, but why bother if I'm going to need to buy more stuff again tomorrow? Or if I'm anticipating maybe some volatility in my own currency and I want to be holding value in something that I know is going to have use on the global marketplace. So I think there's a pretty compelling argument why it's just more efficient after a while to stop swapping one currency for another and just say, you know what, I'm going to need the XRP again next week. So why not just keep my money in XRP until that time comes? So that's a theory, and I think it makes logical sense, but that's sort of what that's about. Okay, so each of the 6 models are in here. I'm going to not go through each of them one by one because I have done separate videos on all of them. To me, I think the big takeaway was really looking at how the variables interact with one another. And it was very clear to me from looking at all of these across all 6 that, once we start to see the transaction utility go up, the store of value element is really where we see massive price increases, because it's being pulled out of the available supply, and you're sitting on it in the same way you sit on pile of gold, if you have pile of gold, or your retirement account, or whatever it is you have as your family's wealth. And if you're not using it for transactions, it means you're not selling it to somebody else. You're sort of pulling it out of the supply. And then basic law of supply and demand means that there's less available for a transaction, so the price of it will go up as well. We have another page in here that really gets deeply into this idea of collateralization, because that was another point of confusion. And that when assets are tokenized on a ledger like the XRP ledger, they aren't in XRP. Like, they can be valued in their own, whatever their a tokenized asset up. So for example, if you tokenize like a bunch of platinum on the XRP ledger, and that's what the value is this tokenized asset of platinum. But if you ever want to sell it or transfer the property rights to that platinum to somebody else, it has to go through XRP. And so the way we like to look at this is that all of these assets are, like the tokenized assets on the ledger, are like a balance sheet for a company. So it's more of an accounting viewpoint than a technical tokenization. And when all of these assets are tokenized on the ledger, it's sort of the balance sheet of the ledger. If you had to look at the value of all of those, that would be considered, that would be done in XRP. And the idea too is that if almost like an insurance policy where you have umbrella coverage, this is something we did cover in one of the model breakouts, is you have to sort of have enough coverage to cover any worst case scenario. Otherwise, your insurance is insufficient. So we sort of looked at this like insurance coverage. It was comprehensive to cover all of the money potentially in the world. There's way more money in the world than you might realize, or I certainly realized through this process. And that is really what collateralization is. It's not a technical issue. It's really more about an accounting issue. And I'll read the summary in this paper if you like to get more detail on that. So that is my quick take on the 6 models and this experience of building it. We're not predicting any prices. That was really never the intent. These could potentially be used to understand the harm of the SEC lawsuit on people who held the asset. If that were to happen, there needs to be some kind of set of valuation models to make those determinations. And then at an academic or intellectual level, it was very interesting to see that store of value is absolutely the biggest driver. But we're going to probably see this concept called the virtuous cycle kick in to make that store of value extremely attractive to people who need to put their money somewhere. If you have any questions, feel free to drop them in the comments, and I'll see you in the next video.